Hi, and welcome to Solution in YouTube channel. This video will cover DuPont analysis that covers three ratio to explain the true meaning of return on equity. So, return on equity is a closely watched number among investors. It is a strong measure of how well a company's management creates value for its shareholders. The number can be misleading, however, because it is vulnerable to measures that increase its values while also making the stock riskier. So, without a proper way of breaking down return on equity components, investors could be a bit of misguided or misled into believing that a company is actually a good investment when in reality it is not. So, with the help of DuPont analysis, we can break apart return on equity and gain a much better understanding of where movements in return on equity are coming from. So, the beauty of return on equity is simple because it is very simple to calculate. So, we need just two things: first, net income, and then shareholders' equity. We'll divide net income with shareholders' equity and we'll get the answer as return on equity in percentage. So if this percentage goes up, it is generally a good sign for a company, as it is showing that the rate of return on shareholders' equity is rising. So shareholders are getting a better value. But the problem is that this number can also increase simply when the company takes on more debt. More debt means that shareholder equity is less. So, this would increase the company's leverage, which could be a good thing, but it will also make the stock much riskier. So, this is why we will be using more in-depth knowledge of return on equity to avoid mistaken assumptions. In the 1920s, the DuPont Corporation created an analysis method that fills this need by breaking down return on equity into a more complex equation. So, the three-step equation of DuPont analysis breaks up return on equity into three very important components. So, first one is net profit margin. Then second one is assets turnover, and then finally the equity multiplier. So net profit margin is simply the measure of operating efficiency. Assets turnover is a measure of assets use efficiency, and equity multiplier is the measure of financial leverage. So the three-step DuPont calculations are as follows. Taking the return on equity equation, return on equity is equal to net income over shareholders' equity. So the first step is to multiply the equation by sales and then divide by sales. So by doing this, we will get return on equity equaling net income divided by sales, then multiplied by sales over shareholders' equity. We now have return on equity broken into two components. The first is net profit margin, and then second is the equity turnover ratio. Now, by multiplying this with assets and then dividing by assets, we end up with three-step DuPont identity. That would be equal to return on equity equaling net income over sales times sales over assets times assets over shareholders' equity. So, as you can see, we have broken the equation of return on equity into three distinctive ratios. So, we will be discussing these three distinctive ratio components separately. So we have return on equity broken down into net profit margin, that takes how much profit the company gets out of its revenues. Assets turnover, that tells us how effectively the company makes use of its assets. And equity multiplier, that is a measure of how much the company is leveraged. The usefulness should now be clearer. If company's return on equity goes up due to increase in the net profit margin or assets turnover, this is a very positive sign for a company. However, if the equity multiplier is the source of the rise and the company was already appropriately leveraged, this is simply making things riskier. If the company is getting over leveraged, the stock might deserve more of a discount despite the rise in return on equity. The company could be under leveraged as well. In this case, it could be positive and show that the company is managing itself very better. Even if the company's return on equity has remained unchanged, examination in this way can be very useful. So, suppose a company releases its numbers and return on equity is unchanged. Examination with DuPont analysis could show that both net profit margin and assets turnover decreased. Two negative signs of the company, and the only reason return on equity stayed the same was a large increase in leverage. No matter what the initial situation of the company is, this would be a bad sign. So, this was a brief but comprehensive explanation of how to break return on equity using a DuPont analysis. So, hope you guys have understood the concept. And if you guys have any confusion, you can ask in comments. So, stay tuned to Solution In, and we'll see you in our next video. Take care.